So we saw the snapshot year one, right? Cleveland is winning on cash flow. Jacksonville's losing by a mile on cash flow.
Yep.
But at the end of the day, the moral of the story here is if we're looking at in 5 years, we're maximizing cash flow in 5 years,
Yep.
this would include a cash out refinance 5 years later, right? So you harvest the equity to take the cash out at the 5-year mark on the clock.
Exactly.
Why do you do that?
Well, number one, and this is what we just taught on I believe it was last Thursday or 2 Thursdays ago. So I hope you all joined us for our cash out refinance special webinar. But what I'm trying to share with all of us, all of our clients, even those who aren't clients that own rental properties, that own real estate, is we are sitting on trillions and trillions of dollars of equity. So why do we do a cash out refinance? Because if all you're doing is you're sitting on your equity and you're not doing anything with it, it's like you're trying to get to your financial goals with one hand tied behind your back. You have this resource. Equity is a resource. It's a tool that can be turned into income for you. It can be turned into a return on investment. Because if all you have is equity just sitting there, your return on equity is zero. You have to financially engineer this. You have to work to put that money to work for you so that it can help you get to your financial goals. So with all of our clients, we're working on this with you, right?
Yep.
We're sitting down and we're saying, okay, well, we've got this equity that's now built up. You have financial goals that are more than where you're at today. And we're saying, well, how can we use that equity that has been built up? One of the tools to be able to do that is a cash out refinance. And a 5-year timeline is a very good, very realistic timeline. It can be shorter than that. It can be longer than that. For you, it's actually a little bit shorter because we've had so much home price appreciation.
Correct. For me, like the numbers started getting interesting right around 3.5 years. And I was just kind of like still making that decision as it ages, it gets better and better. Right. So like 5 years is a good like benchmark of, I guess we've never really said this, but it sounds like if I'm an investor in JWB because I'm investing in a growth market like Jacksonville, every 5 years you should really consider this, right?
Well, we should be talking about it a lot, and not just at the 5-year mark. Your JWB team understands how much equity you have in your home. We analyze this for you. We do this on a quarterly basis, and we analyze the market value of your home for you on an annual basis. So we have the data, and our team is reaching out to you whenever we're talking or whenever we're doing a portfolio review, and we're saying, hey, look at this equity that you have here. This is a resource, a tool that can be used to accomplish your financial goals quicker. So yes, at the 5-year mark, that's kind of like a general rule of thumb. That's how we kind of build out these assumptions. But we should be talking about it. If home prices have gone up tremendously at the 3-year mark, that's the kind of the conversation we're having. Some clients might have a combination of homes that are owned free and clear and with debt on them. Well, if there is a goal that is much higher than what it's at today, we might want to have that conversation 2 years after you purchase the homes and say, hey, is this still the goal? This is something that we can do to help you get to your goals faster. A cash out refinance might be there. So that should be an ongoing conversation and something that, that's a part of the relationship that we build with clients to make sure that they can be prepared for that.
Yeah, that's why you invest with a team that knows how to do this stuff. It can help explain it to you and give you options and do the research for you and present it to you so you don't have to do all that work. Ken Potter is saying something that I think everybody can echo with, right? This idea that I hear you about the cash out refinance, right? But with like rates so high, it's hard to consider that. Am I assuming that this is a case-by-case basis based on like what your goals are, not just like if it's rates this, then you do that. If you have this much equity this, then you do that?
Here's how people get over the rate thing. Rates are higher than what I want right now. I get that. But here's why folks decide to take action and do a cash out refinance and invest in more properties or do something even though rates are a little bit higher. It's because it shaves off years to accomplish your goals. So you can sit down with my team. We can understand what your goals are. We can run the scenario. We can say, hey, listen, if we were to do a cash out refinance and we were to go ahead and acquire these assets and then we helped you pay down this debt that much quicker, we could shave 11 years off of your timeline to accomplish your financial goal. And so when people see that, they're like, yeah, well, rates are a little bit higher than what I want right now, but I'm in for shaving 11 years off of my timeline. Right.
Yeah.
So that's how we connect the dots here. And if you weren't a part of the last webinar that we did, just reach out to our team. We're happy to send you a link to it because I actually just showed that exact example of taking your current client's portfolio, doing a cash out refinance, acquiring the right number of homes for that client, and then strategically paying off the debt using a certain strategy that at the end of the day shaved 11 years off of his timeline to accomplish his financial goals. So that's how you get over the interest rate thing.